Hi, we're Fanatic, a youth-run nonprofit that aims to educate the next generation of youth on crucial financial topics. Through clubs, publications, interactive workshops, newsletters, and speaker events, we hope to provide accessible, informative financial literacy knowledge and raise awareness about financial illiteracy. FinaticTalks is Fanatic's very own set of finance-related speaker events. Today's event is co-hosted by myself and Alex.
Welcome back to FinaticTalks Investment Banking Speaker Series. Joining us today is Todd McMahon, Head of Investment Banking at Capstone Partners. He has over 20 years of transaction and corporate executive experience. Thank you so much for taking the time to speak with us.
It's my pleasure.
Awesome. To start off, as Head of Investment Banking Capstone, how would you define investment banking?
Caramba. So investment banking, you can think of it as really, I'm not going to say selling money, but there's many different facets to it. Certainly a lot of it covers, corporate finance activities as it relates to capital raising, whether it's equity or debt. If specifically you look at the type of things that Capstone does, it's really, we do a number of different things, but really focused on what we call sell side M&A advisory, where we're helping clients find strategic or financial partners to kind of take their business to the next level.
Awesome.
Yeah, so you kind of just talked a little bit about the bank you work for. What exactly is the role you play in the bank?
What is the role I play in the bank? It's a bottle washer, this, that, cook. It's varied. So here at Capstone, a lot of us in management, we will wear two hats, and certainly in hat number one is actually being a deal doer. So in addition to being the head of investment banking, I actually work in the business services practice, where we are advising clients, and all of us from the CEO on down, we'll have a stable of clients and folks that we work with. But as a head of investment banking at Capstone, it really is working with the various banking groups, a lot of our very partners, outside of the firm, to really just move the goals of the firm forward, whether that's on origination, client execution, or even specifically helping employees and junior level talent get to the next level of their careers, whether that's with investment banking or if they go private equity or some other route. So it's a pretty large hat. But certainly, like I said, what's kind of unique about us is everybody still does deals on a day-to-day basis.
Awesome. So throughout your career in investment banking, you've worked extensively in mergers and acquisitions, otherwise known as M&A. So for those who don't know, what exactly is M&A, and how do investment banks help companies with mergers and acquisitions?
Right. So M&A is just that. It's pulling together two organizations. Generally you're working on one side or the other, so it's sell side or buy side. And sell side is just what it sounds like, where a client is desirous to find a partner, and maybe doesn't know how to go about it, isn't necessarily sure who that partner should be, how their business would be valued, optimal positioning. So in an advisory capacity, we'll be working with the client, kind of pre-marketing for all those different things. But even then, kind of taking the deal to market and initiating the dialogue with partners, having those conversations and working towards, ultimately consummating and closing a deal. On the buy side, it's a similar process, but from a different vantage point, where clients will approach us and say, I'm desirous to acquire a company that looks a certain way. And same drill. Maybe they know some targets of what they look like. Frequently they don't. And so it really is kind of coming up with ideas and different things for them, different opportunities, approaching the targets, again, having that dialogue. And if there is a connection to be made, working on the structuring, the valuation, and the closing diligence and all that kind of stuff. So, in our world, that's kind of what Capstone probably spends the majority of our time doing, but certainly there are other services that the firm offers, but in the M&A world, that is where we're spending the bulk of it. And at our level too, it's worth pointing out that at Capstone, we really kind of focus on the 500 million and below type of transaction, what we call lower middle market. And so for us, there's just much more sell side work there than say buy side.
Got it. So why might a company consider a merger or an acquisition?
Oh, great question. 1,000 different reasons. And so, at Capstone, our practice tends to be, we work with a lot of entrepreneurs, sometimes second and less frequently third generation businesses. And it can be a multitude of reasons. whether it's a situation where the entrepreneur, he or she is desirous to take some chips off the table, go to Florida, go to Fiji, whatever that may be. Sometimes there's that desire to do a career change. Very often, it might be a situation where the company is on a certain growth trajectory and the recognition that they might need a strategic partner to help them continue that growth. So whether it's access to new products or services, new customers, different sales channels, whatever it may be, that might be part of the equation. I think what we're seeing more and more at our level, the growth of the private equity investor, the financial sponsor. I mean, when I started working this business 25 some odd years ago, there were dozens of financial sponsors. Today, there's thousands. And so the growth of the private capital markets, we certainly deal with a lot of equity players that are desirous to put money to work in these businesses, take them to the next level. It's a great technique for owners, entrepreneurs to take some risk off, de-lever their life, if you will, de-risk their own personal kind of net worth, but stay active in the business, help that business grow to the next level. And that that buyer base has, like I said, has grown dramatically. So there can be a whole number of different reasons why somebody would pursue it. It's fascinating about investment banking is that no 2 days are ever the same, no two clients are ever the same. And so if somebody wants a front row seat in terms of how value is created, I don't think I can think of a better career, to tell you the truth.
All right, so we often see successful buyouts or sellouts in the news. What are some of the risky factors throughout the M&A process?
Oh boy, there's a lot of them. I mean, so the risk can even start with the idea of wanting to undertake a transaction. The strategic complications, the competitive issues with a competitor, or even potential employees finding out that somebody is considering a transaction, it can cause a lot of anxiety. It can be nerve-wracking. And likewise, if it does leak out in the marketplace, competitors, vendors, your whole supply chain, all these things can be disrupted, or there can be rather, conversations that will be had anytime that somebody is considering a sale. So the risks aren't insignificant. What we find again when we deal with that entrepreneurial business, one of the major risks is that our clients have a day job and they kind of take their eye off the ball, because what we do is not to be it's not to be taken lightly. It's the biggest investment a client makes is generally time. There is a significant time investment to it. And so the risk is, while they're thinking about the deal and working on the process, they need to make sure that they've got a strong team running the business, doing the day-to-day, responding to the whole ebb and flow of the marketplace, customers, clients, employees, all the various stakeholders. So it's actually a process that is fraught with risk. And truth be told, that's why the M&A advisor exists. Certainly some companies, get bought, where you pick it, a Google or a Microsoft just shows up on the front door with a whole truckload of cash. That certainly does happen. But for a lot of our clients, and at the, I'll call the lower middle market, it just isn't that efficient. Buyers and sellers don't necessarily know each other, nor do they really kind of understand what are those things that drive value in their business. I mean, very often what we'll see as an entrepreneurial business will be very successful. It'll be great at providing goods and services to its client base. But when it comes to things like thinking about the value drivers of a business, whether it's customer concentration, protecting the intellectual property, how the care and welfare of the employees, all these different things, very often they won't look at their own business through the same lens that an outsider would. And so again, part of the value of any advisor is working with the client to shepherd them through that process, to mitigate the risks, to try and get it done in a timely manner, value maximizing manner, and the highest probability of close.
Gotcha. Now that we know a little bit about investment banking and mergers and acquisitions, what personally brought you into investment banking, and more specifically mergers and acquisitions?
Oh, it was an accident. That's easy. This was when I left business school. I was not planning on getting into the M&A business. For me, I really thought I was going to become an equity analyst. So certainly that side of Wall Street has changed considerably. 25 years ago, it was a much more robust practice in terms of sales, trading, research. But when I came out of B school, everybody kind of wanted to be the equity junkie and kind of be the next Peter Lynch, the next Warren Buffett. So I was on my way to go do that. I actually got a recruiting call. It wasn't something that I had applied for, but I got a call from the old Bank of Boston. And the recruiter reached out to me, and I thought they wanted me a commercial banker, which is something I wanted no part of. So I returned the phone call, but the same token, I think I was also pretty arrogant's not the right word. I don't know what it was, but saying, hey, look, I appreciate the call, but I don't want to go to work for a large commercial bank. And they said, whoa, hold your horses. This is actually for the investment bank, for the emerging market investment bank. And back then, Bank of Boston had a fairly large franchise in Latin America, and I really didn't know much about it, but I got fascinated by that. It was more credit products, Euro bonds, medium-term notes, different things like that, syndicated loans. And I did that for a number of years. Really liked the corporate finance bug. And then a friend of mine from business school was working at a boutique investment bank. So Bank of Boston, kind of a larger institution, a boutique firm. And this was right when the whole .com boom was going crazy, and deals were kind of happening on a daily, if not hourly basis in the tech world. And I morphed over to that, and there's been kind of no going back ever since.
Awesome. Investment banking is known as a very lucrative industry. How do investment banks make money? And specifically, how do they make money through a merger or an acquisition?
Well, at the end of the day, we make money. We have to close deals. So the way the industry is set up is that it's success fee oriented. So what's interesting is that our risks are very much aligned with a client. If the deal doesn't close, and certainly the client can step off a deal at any time in the process, including night before close, day of close. But the way we make our money is it sounds kind of I guess trite, but it really is meeting the transactional expectations of the clients, and whatever those may be. So certainly price, terms, conditions, those are important, but more often, what you find is that making sure that there's kind of that shared culture, that the match that you're making, which is going to last for years and years and years and maybe decades, it's the right match. You've got the right DNA at the table. You've got the right people, all that kind of stuff. So that's how, by doing that, by figuring out what is the best fit, affecting that transaction, bringing the parties to the table, working through all the objectives, trying to get to price discovery, where the transactional, the price meets all the different transactional goals, and again, good stewardship and all these other things, the deal has to close. And when the deal closes, that's when we get our fee. But if we weren't closing deals, if we weren't successful at meeting the client's expectations, wouldn't be much of a business to talk about. So what's interesting about Wall Street is it can be very Darwinian. Either you're getting it done or you're not. It's fairly transparent. It can be a little bit of a dog eat dog culture at times. One of the cool things about Capstone is that that's kind of not us. We have a lot of folks like myself who have been in that and kind of seen that and say, I still want to be able to go home and, see my family and have a life on weekends and do all those other things that make us human beings. So that's kind of one of the cool things, I think, why so many of us have been at Capstone for so long. But fundamentally, to go back to the question, we help clients achieve those transactional goals. And if we didn't, we wouldn't have been here for 20 some odd years or whatever it's been.
Yeah, so along with the money, investment banking in general is known to be a very difficult industry,
Right.
whether that be the long work hours or hard technical work. What are some of the common challenges that you face as an experienced investment banker?
Oh boy. Well, so I'll tell you this, one of the challenges the industry is having right now is people. And you guys kind of hit it right in the head. When I was coming out of undergrad and grad, investment banking was really kind of it. It was where people wanted to go. And today, there's so much more competition for good talent. Never mind in the financial world, things like private equity and family offices and hedge funds and all those different things, but even like startups and a lot of the kind of the interesting opportunities that are out there for anybody who's good and has skills and can be kind of a critical thinker. So the biggest challenge for the industry, I think, is people, is getting the right people, getting people that are kind of attracted to the service model. So that's kind of thing number one. I think right now, specifically where we are in the cycle, there's obviously going through COVID, where it was a year of contraction. And now as kind of the vaccines are doing their thing and getting out there, there's specifically right now there's a concern about raising capital gains rate. So there's an awful lot of activity. I think everybody in investment banking, certainly everybody in M&A today, it's crazy busy, very much a contrast to where we were a year ago. So, for us and where I sit, thinking about as a firm, how do we manage that? How do we manage that deal flow? How do we manage that transaction flow? How do we manage our people so that people aren't getting burnt out? They can get away, again, do the things that make them human. And then same thing, when we look down the road, if we think about where we were last year, where we are today, if anybody can tell me where we're going to be in a year's time, that's a question I'd like to know the answer to. Just because right now in the environment, given COVID, given this Delta variant, who knows what's going to happen to that, but it just really is a very unique time to be doing what we're doing. So it's managing that on the firm's behalf, making sure that we're consistent, with our quality of service, and we continue to give clients the best advice and the best advisory we can. That's no small challenge from where I sit. And again, making sure that we can find the younger folks that say, hey, this is a cool place to be, or this is a cool industry to be. That's no small thing either.
Got it. So going more in depth into the technical side of M&A, what kind of work and due diligence goes in before the actual transaction?
Oh boy. A whole lot. How's that, Alex? Answer your question. The work, and especially kind of at the junior level, it is varied. So you mentioned this before. There is a lot of called technical work where people are working on, comparable transaction pools, comparable transaction analysis, putting, different stats and data into PowerPoint, into Excel. I mean, it's I think when somebody starts their investment banking career, getting those kind of rudimentary skills down is always a challenge. It's a little bit like drinking from a fire hose. And again, in today's environment where there is so much activity, that's not, no small thing. For us, what we want to transition people to, it's great to be able to get everything in Excel and make it look pretty in PowerPoint, but what is the data really saying? So it's one thing to kind of to do the computation, and I think it's another thing to really kind of read and understand it. So for us, I love it when I see accountants, when I see CPAs, when I see people that, maybe coming out of undergrad who've had a lot, maybe more accounting, truth be told, than corporate finance, because accounting, is the language of business. So the technical chops aren't insignificant. There's a lot of systems, whether it's something like a Cap IQ or a FactSet, that maybe people haven't seen or experienced or used before. So getting them up to speed on those. Financial modeling, understanding the correlation between an income statement, a balance sheet, a cash flow statement. There's a lot of investment bankers. There's a lot of senior investment bankers that, truth be told, maybe don't do that as well as they should. So for us, getting people that really kind of understand, call it the finance, the accounting side, and understanding that on the one hand, certain assets might look good. It's good to have receivables, but then somebody's saying, well, wait a minute, if those receivables are growing, I'm not necessarily collecting the cash, so my whole cash conversion cycle, that kind of thing. Having people that can take that next step and go from beyond just spreading the numbers to really understanding what is the story in the numbers. Why are those receivables climbing? Are customers not happy? Are they not paying? What really is the story? Things like that, where people start to really kind of get the wisdom and the insight. That's always fascinating to watch people, go through that process.
Gotcha. So can you just share some of the common methods you use when valuing a company pre-acquisition or merger?
Sure. What we will do, and this is where there's some part of his art, some part of science. So we're going to look at I think a lot of the same metrics and a lot of the same methodologies that everybody else is going to use. So specifically, we're going to look at public comparables. How is the sector trading? What are the trends? Whether it's price to, EBITDA, net income, earnings, book value, depending on the industry. So we're going to look at share prices, share metrics, all that kind of stuff, and try to get a sense for, in any given sectors, what are the winners, what are the losers, what's driving that. Very often in our world, public capital markets are kind of, where the buck stops, if you will, and that you'll get the highest and best valuation, sometimes in public equity markets. So understanding what's driving that, we'll look at those comps. In our world, we may have to make adjustments for things like liquidity and size, but that's part of the analysis. So we'll look at public comps. We'll look at, we do things like discounted cash flow and an LBO analysis, where we're trying to understand, the cash generating capabilities of those businesses, what it might look like in a levered situation. Again, with the growth of private equity in our niche of the world, understanding, how they achieve their return targets and the return hurdles is no small task. So we'll do that. And we'll also look at, kind of M&A comparables and say, what is the activity? What is, what is the market valuing? And very often, again, depending on the sector, we might bring our own proprietary insight. So based on conversations that we're having with buyers and based on things that we're seeing as value drivers. So we'll kind of do these 3 or 4 different methodologies. It may change on the sector. We have 12 different industry verticals that we cover here at Capstone. They're all going to trade a little bit differently. So each team may have their own kind of, methodology or their own customization of that. But generally, we'll look at those 3 or 4 different methodologies, try to give them a weighting and say to the client, look, here is the trading range. This is what we think would be a fair market value. And then as it pertains to your particular opportunity, here are the things that we think are compelling. Maybe these are some other things that we don't understand as well as we should about your specific business. So let's dive down deeper into those topics and kind of understand that. But the idea from our perspective is we always want to be aligned with the client before we go to market. We want to make sure that we're kind of seeing the world the same way, that there's that shared understanding. If somebody comes to us and says, hey, I think my business is worth $1 billion. And we look at it and we say, well, geez, we think it's 250. That might be, enough of a separation that there could be some heartache there. So making sure that we all, or have that shared understanding and that we understand going into a process, what's a good outcome, what's kind of a reasonable outcome, and why. What are the facts, what's the analysis that's driving it? And same thing, our junior staff will certainly spend a lot of time working with the MDs and the directors and the VPs to prepare that analysis, understand each client situation, and try to figure out, is this opportunity, is our client, is it more or less or kind of neutrally attractive to its peer group, and why? So we'll do that on the front end, and it's probably, we'll do that, have that understanding, but then after that, it's very often it's a situation where the market will speak.
Yeah, so speaking of markets, something that we see in today's market a lot are, large public companies acquiring small private startups. So have you ever advised a merger or acquisition involving public companies?
Sure.
And if so, how does the process differ from advising a private company?
So the main difference is how am I going to put this and not offend any listeners? It's a lot more political. I mean, to tell you the truth, when you have a public company, there's so many different so many more stakeholders at the table. And so very often, I think what you find is that the board of directors is trying to kind of, handicap that. And, is this opportunity, how is it going to be viewed by the street? Will the analysts like it? Will they not like it? Is this a good thing? Is this a bad thing? So, it's certainly a very different dynamic. Let's say when you're working the buy side for a public company, we certainly have done it before, but it can be a different set of metrics because again, you've got that kind of, third party at the table being Wall Street and analysts and expectations. So it can add a layer of complexity. It can add a layer of politics. And it's just a little bit different from working in the world of privates. Not any better, not any worse, just different.
Got it. So within the public company acquisitions or mergers that you have advised, is the outcome of the company stock usually higher or lower than the pre-acquisition or pre-transaction stock price?
So that's interesting. Usually the board is going to, get out in front of it and say, okay, look, we want this to be accretive. They want this to be something that moves the share price. And more often than not, it is going to have a positive impact. I think what you find is that, we call them story deals, the deals that maybe need a little bit more explanation of this and that. Those are hard to get done, anytime. They certainly do happen, but generally it's a type of thing where management, the board will go looking for a certain type of company, a certain asset, because the expectation is, they have an ongoing dialogue with their institutional investors, their analysts saying, if you were to do this. And so whether that's, let's say, increase the product or service line a certain way, maybe open up a new geography, get into a new line of business. They already kind of know what they're hunting for and why, and assuming that job is done well, it's usually a positive. It's usually a positive spin. What's interesting is that it's hard to find courage on Wall Street. So if you're looking for somebody who's going to kind of step outside and do something truly brave and risky, I mean, that's when you talk about the Musks of the world and the Bransons and the folks. On the one hand, people say they're crazy, and on the other hand, when it works out, they do these amazing things. Those are the exceptions, and that's why we know them on their kind of first last name basis.
Gotcha. Another transaction term we've recently seen on the news is hostile takeovers. What exactly is a hostile takeover, and have you or your team ever advised one?
I have not, and truth be told, yes, they're around. I don't think they're as popular as they were, say, back in the 80s. But a hostile is just that. It's when one organization generally makes a move on another organization. Usually that other organization is public, the target. And maybe it's a situation, the classic hostile takeover is kind of the situation where you have a publicly traded company, maybe a little bit sleepy. It's kind of cruising along. Maybe it's a dividend producer, maybe not, but it's kind of, off the beaten path. And somebody believes, a lot of these activist shareholder types believes, hey, look, this could be a better company if this was run more efficiently, if maybe the org chart was rationalized, or maybe there are things that could be done with the balance sheet. Somebody coming in saying, I think you'd be better if you did X. And usually what that means is there's going to be kind of a head-to-head clash between management, because obviously the managers at the sleepy company think they're doing just fine. So the classic hostile is somebody's looking at a company, looking at an asset, saying it's undervalued, maybe being undermanaged, and with a little bit more horsepower, the company could be doing a better job, and then puts an offer out there in the public domain saying, look, I'm willing to buy shares at X or Y, usually pretty aggressive premium. And as you can imagine, it's usually not well received, hence the hostile by the existing management. So that was kind of the rage when I broke into the business. There was a lot of that going back in the, what was it, the Drexel Burnham, and using, high yield debt and junk bonds to kind of finance the same. You still see it now, but I think today there's probably more, again, like I mentioned, the activist shareholder, folks coming in, to a company, buying a significant position and saying, I don't need to do the full hostile, but if I can get the board, or if I can get management to pay more attention to these issues and affect change this way, then that could be a way to move the needle on certain things. So we see it, it's out there, not so much at the level that we play. I think it's a little bit more, the deal making these days is a little bit more consultative.
Yeah, makes sense. What is the largest merger or acquisition you or your team has facilitated?
Oh heavens. I'm trying to think. We may have a couple this year that cross $1 billion. Personally, myself, going back in the day, I mean, I started my career. One of the largest deals I worked on was the Republic of Panama sovereign Eurobond issue. And that was kind of a bank deal. I can't remember. I think it was $1 billion transaction or something like that. Back when $1 billion meant something, today it seems like everything is $1 billion plus. But like I said, my career has been kind of more focused lately on the sub 500. It's interesting too. It's worth pointing out that it doesn't, smaller deal doesn't mean it's any less complex. In fact, I think sometimes smaller transactions can be harder to do. When you get two large organizations and it makes all the sense in the world, and both sides are cheering it on, sometimes it gets this critical mass where it just closes. There are other times where it's kind of, you're pulling everybody together and there's a million little details that have to get solved, addressed before the transaction will close. So it isn't always a case of size being kind of the big thing. I think what's interesting for what we do as well, and I hear this from a lot of folks on the floor, is that because we are working with entrepreneurs, I have a client that has said to me multiple times, what you did for me and my family, it changed our lives. It changed not just, my kids' lives, but the grandkids who aren't born yet and their kids, because the type of generational wealth that is created. And so what's interesting is, I get an email, I get a text from this client every anniversary of the deal closing, because it was such a significant event in their life. And that's kind of cool. I'm not sure if I would get that if I was putting together, Apple and Tesla or something like that. Not saying that the rocket ride wouldn't be cool, but there's something neat knowing that you're really impacting people's lives and taking care of whether it's tuitions, houses, weddings, setting people up, generation, that's kind of a cool thing too.
Yeah, that's really, really awesome. So as a final question, one of our social media followers wanted to ask you if, if you have any horror stories or funny experiences relating to your time advising M&As.
Horror stories? Oh boy, oh boy. Too many. When I say horror stories, too many to mention. I mean, so I'll say this: pre-COVID, we traveled a lot. So everybody in our industry and our business has got a horror story of getting snowed in here, iced over there, stuck for 9 hours in the middle of nowhere airport, and food poisoning and all that kind of fun stuff. So that comes, and likewise, everybody's got the deal stories of unfortunately things do break at the closing table the night before. So those are heartache. Those can be tough to take. So yes, we've all got all kinds of crazy trains, planes, and automobile stories. We've all got crazy stories about it was a done deal, it was guaranteed gonna close until it didn't. So that kind of comes with the territory. I think what's interesting is to have success in our business, and specifically M&A, where it tends to be binary, either the deal closed or not. It takes a certain tenacity. It takes kind of a certain kind of emotional, mental makeup to kind of do this, where you can work on a deal for literally weeks and weeks and weeks, months and months and months, and you get to that day of close and it doesn't close. Or conversely, when it does close, oh yeah, there's ringing of bells, there's popping of champagne corks, there's going out to the restaurants and doing all the celebratory things. So getting people that kind of are built for that, and can kind of take the emotional roller coaster and the ups and downs. I think we have a lot of type A folks where the deal has a good day, you have a good day, the deal has a bad day, you have a bad day. So be able to manage those horror stories and kind of put the good away and keep them for the bad. No small part of what makes somebody successful in our industry.
Absolutely. And before we wrap this up, is there anything you want to tell our young listeners about the corporate finance world, investment banking, or mergers and acquisitions?
I would say this: I think it's gotten a bad rap. I think, again, people coming out today, there's more choices. I get that. And there's some really, really cool things to do. But like I said, one of the things that's really interesting about investment banking, and we know not everybody's going to be here for 25 years. People want to do different things and have different experiences. That's all good and proper. That's all fine. But I think what's interesting about investment banking is certainly at a place like Capstone, where you get exposed to so many different clients, so many different business models. And one of the things we try to do with our analysts and our associates is to put them on different teams. So you go into services deal, you go into manufacturing deal, you get exposed to these different industry verticals. But at our practice, you talk to the entrepreneurs and you get to hear the stories of the hardships that they went through and the difficulties they had, the challenges, the obstacles they had to overcome to get their business where they got it through. Like I said, you get this front row seat in terms of value creation and all the goods and bad of being an entrepreneur. So I think what's interesting about investment banking for everybody starting their any kind of professional career, and we have people do this all the time, where they come in to say, I'm going to do investment banking, I'm going to scratch this itch for the next 2 or 3 years. And certainly your financial chops, the ability to model and understand, corporate finance, your ability to kind of understand that value creation process. It provides a great foundation for whatever people want to do from there, because you really will get a mastery of certain skills, but an understanding just business acumen that I think is kind of second to none. I think a lot of people I see, they come out, they go to work for an organization, and they might get very deep in a specific function, but it might be very narrow. And so what tends to happen in investment banking, I think, is you get to see all these different parts of not just the finance world, but the economy in general. And so then in terms of somebody's next career move and career path and whatever they want to do, the experience and the skills that they're going to get is going to be second to none. Yes, the hours, the work is the work. It's when I say it's a lifestyle business, that can have negative connotations too. I think COVID has taught all of us the importance of being kind of that well-rounded human being. But it really is a great way, I think, for anybody to start their career, just because you get exposed to so much, you see so many different things, and it will help you kind of figure out what it is you really do like, what you don't like, and what the next steps are that make sense for you.
Yeah, that's some great advice. So that'll be it for today's guest speaker event. We appreciate you tuning in, and most importantly, we want to thank Mr. McMahon for the time and the opportunity.
Guys, everybody, thank you. My pleasure.